Hello and welcome. In this recording, we are going to discuss chapter 4, that is banking services of financial institutions. So, we are going to discuss briefly what are the different services available in different financial institutions. So, how do you manage cash? So, you can manage cash by keeping it cash, check, credit card, debit card. That are the most common payment ways. So, day to day transactions that you perform, you can either do it in cash, you can do it on check, that is very uncommon these days, credit card, or debit card. Common mistakes while managing cash include overspending as a result of impulse buying and using credit cards. So this is one of the shortcomings of credit card. So in credit card, what happens? You buy things right now and pay later. So because you're not paying right away, you tend to do impulse buying. So you buy things that you don't require because you can buy it right now and you don't have to pay. So one of the results of using credit card is overspending, not having enough liquid assets to pay current bills, using savings or borrowing to pay for current expenses, and failing to put unneeded funds in an interest bearing savings account or investment plan. So these are the common mistakes. So overspending, we tend to overspend. So another mistakes would be that we are asset rich but cash poor. Asset rich means we may have a house, we may have investments for the long term, but we don't have liquid assets to use to day for day to day living. So we are living from paycheck to paycheck. Another issue is you can use savings or borrowing for paying current expenses. So you are not matching your current expenses with current income. You're digging deep into your savings and using those savings to pay expenses and failing to put unneeded funds in an interest. So unneeded funds are just lying in your account. They are not getting used. They are not generating any interest. So financial services for managing cash flow. So financial services for short-term needs, so daily purchases, living expense payment, and emergency fund. So cash availability, savings, checkings, and credit card. So cash availability, check cashing, automated teller machine. So we are going to discuss all of this. Savings, how do you save in regular savings account, money market accounts, high interest? What are checking accounts, regular checking account, cashier's check, money orders, and credit cards? Financial services for, so there are short term needs and there are long term needs. Short term needs are how much cash is available, what kind of savings account are you using, what kind of checking account using, what kind of credit cards you're using. Financial services for long term goals, so GICs, Canadian savings bond, credit services, taking loans and all, investment services, so tax free savings account, mutual fund, etc. So you have money management needs for short term and money management need for long term. Short term needs, you handle what is available in cash, savings, check-ins, and you handle credit cards. For long term, you handle savings but in long duration like GICs and all. Then credit services, long term loans like home mortgages, and investments and other services. So types of financial services. So savings account, time deposits in savings, and investment certificate. So what is time deposit? Time deposit means you are depositing your money for a particular amount of time. It means your money is blocked for a particular amount of time. It can be 6 months, it can be 1 month, it can be a year, etc. Payment services, so automatic payments, you can set up auto payments in your account. Checking account, commonly called as demand deposits, so you can withdraw a demand deposit to pay. Borrowing, for short term and long term you can borrow. And other financial services like insurance, investments, real estate, tax, etc. So these are all the services that are provided by financial institutions. They provide you with savings, they provide you with payment services, they provide you with short term and long term borrowing, and they provide you with other things like insurance, investment, real estate, tax, etc. Electronic banking services. So how does it work? Direct deposit of paycheck and other regular income. So you can either, let's say you're working in SATE, I am working in SATE, so I can either have a bi-weekly check in physical form, then I deposit that into my bank, or I can have a direct deposit. Direct deposit means my salary is automatically credited in my bank account bi-weekly. Automatic payments, you can set up auto payments. For example, if you have a bell connection, if you have a cellular bell connection, you get monthly bills, so you can set up an automated payment for bell monthly. So whatever monthly payments you are going to get, those get auto deducted. You can also do it for tax. So you can have an auto payment for tax. So after filing tax statements, whatever tax is due, that will be automatically debited from your account. You can obtain cash. So there are teller machines. You can go to a teller machine, you can withdraw money from it, check account balances, how much is there in your account. You can even do it on mobiles now. There are various apps, you can access any app to see whatever balance is there. You can transfer payments from one party, from you to your friend, or from your friend to you. Point of sale payments, you can use your banking cards or bank accounts for using for shopping, and you can also do online banking. So mobile banking options, so you can do all these things on mobile. You can do payments or transfers, you can do deposits, and you can do various other services, locate an ATM, apply for loans, etc. So everything is coming on mobile. So there are specific banks that are online only. For example, Tiger Bank, it is online only, so there are no physical locations for it. So you can choose such a bank too if you are doing it only online. So what is an automated teller machine? It's a computer terminal that allows customer to conduct banking transaction. So the thing is, ATM fees have increased substantially in the present. So in earlier days, ATMs means automated teller machines, withdrawals as well as deposits were charged almost nothing or very less. Nowadays, the charges are significant. So you have to be careful while using these machines. So to reduce ATM fees, you can compare ATM fees before opening an account. There are certain accounts that provide certain X number of free transactions a month. So you have to, if you find that you're using ATMs a lot, then instead of going for a fee based account that charges you per transaction, you can go for an account that has certain number of free transactions. Use your bank's own ATM whenever possible because the fees are not there. Purchase monthly service packages that includes a certain number of ATM transactions that are free. Withdraw large amount of cash as needed. For example, if there is a $3 fee, so if you withdraw $10, you would be charged $3, but if you withdraw $300, even then you would be charged $3. So it is better to withdraw large amounts to reduce the incidence of fees. Use personal checks, traveler checks, credit card, and prepaid cash cards when traveling instead of using ATMs. And specifically, if you're traveling to other countries, it becomes important because the fees that are charged are in addition to banking fees. So, if I'm traveling to China, so I would be charged a foreign, means I'm using Chinese currency, right? I'm withdrawing Chinese currency in their ATMs. So I would be charged an additional fee in addition to my regular fee. So that is called as foreign transaction fee. So whenever you are traveling, it is better to use prepaid travel cards or it is better to use cash. Method of payment, you can use it for point of sale transactions. Debit cards routinely accepted in most of the retails and retail chains and restaurants. Your pin is required with tap, that has become very less. So instead of using pin, you can use a tap. So how did it progress? Initially we had swipe cards. So there was a swipe and there was a slip, and then you sign the slip. So the transaction used to happen, you find a thing you want to buy, you took it, you went to the cashier, you swiped your card, the cashier provided you receipt, then you had to sign that receipt and give it back to cashier. That was how it used to be done. Then sim based cards came. So sim based card had all your information in your sim. So with sim based card, you pick up the thing, you go to the cashier, you insert the sim, then you enter your pin, and then you do the transaction. With sim based cards, there is no need to sign your transaction these days. The third form of transaction is tap based. So instead of using sim, your information is preloaded in the tap and interact system is used, and you tap your card, so there is no need for using pins. So personal identification pin is required and money automatically debited, reduces your available funds. Credit card can also be used but charges accumulate. So in credit cards it's different. You keep on shopping, you keep on buying stuff, and when the due date arises, you have to pay those stuff. Stored value card, prepaid cards for phone services, transact and library fees. So example, we have a campus, most of the campuses in Canada have a prepaid card. So whatever you want to buy on campus, let's say food and all, you can have a prepaid card for that, fill that card up each month and then use it for buying food. Smart cards have a microchip for prepaid goods and services and for data such as your medical history, account balance, insurance information. So banking smart cards include information related to your payments, so debit and credit information as well as your pin information. But there are other smart cards that include information on your insurance, on your medical history, etc. Methods of payment, smart cards, sometimes called as electronic wallet, look like ATM cards. However, they also include a microchip. So that was what we were discussing. This many computers stores prepaid amounts for buying goods and services. In addition, the card stores data about your account balance, transaction record, insurance information, medical history. So in not in every case it stores medical history, but if it is a medical card, medical smart card, then it would store medical history. Software based payments, so you have software based payments like Bitcoin that are often referred to as digital currencies. These currencies are electronically created and stored, and like traditional money may be used for buying goods and services. So cryptocurrencies are cryptocurrencies are form of digital payment. Examples are Bitcoin, Ethereum, etc. So this is new innovation that has happened. Opportunity cost of financial services, higher rate of return may be obtained at the cost of lower liquidity. So if you block your money and don't use it, you may get higher return. But if you don't block your money, you can use that money. So liquidity is more, so returns are less. Convenience of a 24-hour ATM must be weighed against service fees. No fee checking account that requires $1,000 non-interest bearing minimum balance means a lost interest of, okay. So when you are opening a checking account, there can be zero balance checking account that charges a monthly or an annual fee, or there can be a minimum balance checking account that doesn't charge any fee. Now, if you choose a zero balance checking account that charges a fee, you are not required to keep any money into it. So you can transfer your money into a savings account, or you can transfer your money into investment accounts. So there is no loss of interest. But if you take a zero fee checking account that has a minimum balance of let's say $1,000, then you have to keep $1,000 into it. So you cannot invest that $1,000. Then there is a loss of interest, okay, on that $1,000. So you have to weigh the fees against loss of interest when opening a checking account. So they have given, if $1,000 non-interest bearing minimum balance is there, you, if 2% interest is there, you lose around $220 over 10 years. Financial services and economic condition: changing interest rates, rising consumer prices, and other economic factors influence financial services. When interest rates are rising, long-term loans take advantage of long-term loans take advantage of current low rates. Short-term savings take advantage of higher rates when they mature. When interest rates are falling, you refinance your loans using short-term loans. Okay. So if interest rates are going to rise, the current interest rate is, let's say, 4%, and interest rates are, you expect that interest rates are going to go to 5%. So what do? Right now you block your long-term loans at 4% instead of waiting for taking loans. So you take on long-term loans because you expect interest rates to rise. So you want to take loans at the current lower interest rate than future interest rate, as well as you invest in short term savings, so that when you don't go for long term savings, because you know interest rates in future would be higher. So you invest in short term savings, let them mature, and then again reinvest in at a higher rate. So what do? You expect interest rates to go up to 5% after 1 year. Current interest rates are 4%. So you take a loan at 4% and block it for long term, or if you want to save, you can invest at 4% for a year, withdraw the money, and again reinvest it at 5%. You do not go for 5 year or 10-year investments right now because interest rates are going to increase. Same way, if interest rates are falling, what are expected to fall, what do? You refinance your loan. So if you have taken a loan at 5% in past, you can refinance it at a lower rate, let's say 4%. So there are refinancing fees that you should consider also. And long-term savings, if interest rates are going to fall, so you have a higher interest rate right now, you block your savings for longer duration. So this is what they have explained. So types of financial institution: deposit types financial institutions. So these are banks, trust companies, and credit unions. So deposit based means their main objective is to take deposit from you and give out loans, and whatever income they generate is the spread. So if they're going to pay you 3% on your deposit and they're charging 4% on the loan, so 1% is their spread or their net income. That is how deposit based institutions work. So these are chartered banks, most of the big six banks as well as other banks, trust companies, so mutual fund trust companies, etc., and credit unions. So these are deposit based institutions. Non deposit based institutions are life insurance companies, investment companies, mortgage and loan companies, pawn shop, and check-in and cash-in account. So what's the difference between chartered banks and credit unions? So credit unions initially started for union employees. So union employees came together and they created a financial institution to cater to their own needs. So let's say I'm a coal union. So we got together, we created a credit union to cater to our own needs. But later on, they expanded to non-union members also. So credit unions right now work exactly as a bank because they cater to non-union members also. So advantage of credit unions are generally they give better rates than what banks do. A better rates in terms of loans, in terms of credit. Non-deposit LIC, life insurance, so companies dealing with life insurance. Then investment companies, like you can buy and sell shares or bonds with them. Mortgage and loan companies, they specifically target credit. or pawn shop is for extremely short term loans. So you are going to get a paycheck tomorrow, but you need money right now, so you can go to pawn shop and take a short term loan for a day and then pay it back tomorrow. So these are called as pawn shop, but the problem is they charge extreme high interest rates. And check cashing outlets. So check cashing, instead of checking, means if you get a check, instead of cashing it at a normal bank, you can go to these institutions or these small shops and cash your check. The problem is they take a huge cut on your check. So 10 to 15% or even as high as 20% of your check they take as fees. Deposit type institutions. Chartered banks offer full range of financial services to individuals, businesses, and government agency. So there are Schedule 1 bank. These are full domestic service banks. Schedule 2 bank. These are subsidiaries of foreign banks in Canada. And Schedule 3. These are branches of foreign institutions. So Schedule 1 bank has to be incorporated in Canada and it has to be a Canadian bank. Schedule 2 bank can be a bank that is a foreign bank but has a subsidiary physically present in Canada, listed in Canada, right? Schedule 3 bank would be a foreign bank that doesn't have a subsidiary in Canada but has retail branches. So these are this is how banking is structured: Schedule 1, Schedule 2, Schedule 3. Trust companies also, I'll give you an example. So RBC will be a Schedule 1 bank, HSBC Canada will be a Schedule 2 bank, and Citibank or Bank of China would be a Schedule 3 bank. Trust companies also offer broad range of services as well as act as trustees. Credit union or means the Quebec term Caisse Popularis are user-owned and non-profit financial institutions offering a range of services. Mostly they offer all services that banks do. Non-deposit institutions. Life insurance companies offer insurance plus investment and retirement planning. Investment companies offers money market fund as well as other investments. Mortgage and loan companies lend for home purchases. Pawn shop make loans on possessions. Check cash in charge 1 to 20% with average being 2 to 3% for cashing your check. Banking via phone or and online with most financial institutions is available these days. Use of online web portals for personal banking has become very popular. So you can verify account balances, you can transfer funds, you can pay bills, you can pay check credit card balances, and you have 24/7 access and virtually it is free to have a financial product with a financial institution. Other online services include pre-authorized debits and recurring transfers, stop payments, check services, email money transfer, downloadable statements, synchronization with accounting software, and phone app photo credit. So I'll explain two parts. Others are fairly easy to understand. So recurring transfers, you can set up recurring transfers. So example, if you pay rent of $1,000 each month, so you can set up a recurring transfer to pay $1,000 each month. Stop payments, if you have shopped something and the product is faulty, so you can stop the payment for it. If you have paid it on credit card, you can cancel the payment until your product or your uh, problem is resolved. Then you can have check services. You can have checks printed for you and you can use those checks for doing payments. Email money transfers that are possible, so you transfer your money through an email link. So a person who receives that money gets an email. There is a password that you can set, and the person who gets that needs to key in that password to get that money. Then downloadable statements, you can download statement, of course. Synchronization with accounting software. So if you're using a money management software, you can sync. For example, let's say you're using Microsoft Money, so you can link or sync your bank accounts with Microsoft Money, so you can track your expenses. We have discussed budgeting, so you can do budgeting in Microsoft Money, and you can link your bank accounts, certain bank accounts, to Microsoft Money. So whatever transactions happen on the bank account, they also come in software. Then there are phone app photo deposits. So example, if you get a check, so instead of physically going to the bank to deposit the check, you can just click a photo of front and back of the check and you can deposit that check. Benefits of online banking: time and money savings, convenience for transaction, comparing rate, no paper trail for identity thefts, transfer access for loans and investment, email notices of due dates. Identity theft is people can go, if you get a banking statement regularly, or if you have certain income tax statements. So certain statements have your personal information like your SIN card, your bank account, your address, your other information, name, birth date, etc. So if you're not shredding those documents properly before disposing them, an identity theft can go through your garbage and get all your personal information and then use it to fraud you. So these things don't happen because if you're using online banking. But there are issues also, like potential privacy and security violations, because your information is available online with the banks, and there have been recent incidences when where major Canadian banks were hacked and information was leaked. So that is something that you have to consider. ATM fees can be costly if you're using only online banks, difficulty depositing cash, overspending due to ease of access, and online scams, phishing and email scam. So just recently I have been constantly getting phones from someone claiming to be CRA, Canadian Revenue Agency, that someone has reported my income, my real income, and there is a misrepresentation on my tax document, and I should pay certain fees online to them to avoid penalties and avoid arrest. So I checked with CRA. So whenever you get such a call, don't be in a hurry to deposit money. Nothing happens. CRA, you have a right to lawyer even if things goes wrong. So, and CRA doesn't arrest you until and unless it gives you sufficient amount of time and ex- uh, means there is a due process to be followed. So I called up CRA and I checked with them. So there is no such thing that is happening. So don't fall victim to such scams. Nowhere you have to deposit money before checking, and disconnect phones from these phishing sites and call the agency on their actual number, and then if they say that you have to deposit money, then it's okay. So call the actual agency. Beware of high cost financial services like pawn shops, payday loans, rent to own centers, and refund anticipation loans. So pawn shops and payday loans are short term loans. So pawn shop is, I have a gold necklace or I have a paycheck that is coming, so I have some asset. I go to a pawn shop and withdraw money based on that asset. Payday loan is cash advances. So I I take certain short term amount of cash advance based on certain paycheck or certain my salary or etc, and then I pay it. So it's again a short term loan. It is similar to a pawn shop. Rent to own centers, you can rent certain things and then own those things later on. And the last thing is refund anticipation loan. So most of the tax filing services offer it. So if you're getting a tax refund of let's say $1,000, but tax refund is going to happen after 2 months, but these agencies provide you let's say $900 right away instead of $1,000 2 months down the line. So you have to be aware that they charge a significant amount of fees, they charge a significant amount of discounts to do that. So it's better to wait for your tax refunds than to take these loans. So you have to be aware of refund anticipation loans because these are actual loans and you have to pay interest on it. Interest can be built into the loan, so they give you a discounted amount, or you have to pay extra interest. So you have to be extremely careful while taking tax refunds right away. It's better to wait. So whenever you are comparing financial institution, which financial institutions you should go for? So you should consider services offered, rates, fees and charges, financial advice, safety deposit insurance, convenience and location, online services and special program, ability to pay bills online, as well as do they have website and mobile based banking, that is virtual banks. So you consider whatever services they are providing. Do they have investment accounts also? Can you trade buy in shares also with them? So is it a one stop financial solution or do they provide only banking? Then you focus on different rates that they are charging, and rates can be significantly different. Fees and charges that they have, financial advice and personalized service that they provide, safety deposit insurance. All banks or all financial institutions are not covered under insurance. So up to $100,000 of your money is insured per account, right? So you have to know whether your bank is covered under that insurance. Convenience and location, online services and special programs, paying bills online and virtual banks. So others are self-explanatory. So checking accounts are interest earn there is a certain type of checking account that is interest earning. So you have checking privileges, you can have interest earned, it is insured, it can be insured, possible service charge for going below minimum balance. So interest bearing checking accounts are a type of checking accounts whereby there is a minimum balance required in the account. If you go below minimum balance, you are charged fees. If you stay above minimum balance, you are not charged fees. As well as it can charge for printing checks and other fees. Then there is Canada Savings Bond, varying rate of interest, regular or compounded interest. It is government guaranteed. It has a low minimum deposit and no interest paid if redeemed before 3 months. So it's a short term investment. You can buy Canada Savings Bond into your account. This was especially famous when we were in World Wars. So World War 1 and 2 was sponsored by Canada Savings Bond, and it has got little less popular in recent times. So it has an interest rate that is linked to the market interest rate. If interest rate goes up, the interest rates on Canada Savings Bond goes up, goes down as the market rate goes up and goes down. You can have a simple interest bond or you can have a compound interest bond. Simple interest bond pays interest into your account. Compound interest bond reinvests that interest that you are getting paid. It is government guaranteed. It has very low minimum deposit. You can start even with $100 or $500, and no interest is paid if redeemed before 3 months. So your money is blocked for 3 months. But if you stay beyond 3 months, interest is paid. So savings alternatives. So instead of having a normal savings account, these are the different options that are there. So you can have a regular savings account or a passbook account. So low minimum balance, ease of withdrawal, insured up to 100,000 per financial institution. Drawback is it has little low interest rate. Then there is guaranteed investment certificates, guaranteed rate of return for the time of GIC insured, possible penalty for early withdrawals, and there is a minimum deposit required. Interest earning, so it is a substitute to savings account. So instead of keeping your money in savings, you can keep your money in GIC. So what have we discussed? There are checking accounts that are mostly non-interest bearing. Then there is an interest bearing checking account that has a minimum balance required. Then there is savings account. Savings account has a minimum balance required too. Okay. But savings account charges fees when you withdraw money from it generally. But you get interest payments on it. Then interest earned in checking account, checking privileges and interest earned insured up to 100,000. Possible service charge for going below minimum balance. Very low if any rate of return. Cost of printing checks, other fees may apply. Money market accounts, favorable rate of account. Money markets. So money markets is where you give your money to for okay. So there are two types of markets, capital markets and money markets. Money markets are used by governments, individuals, and companies to raise money for their short term requirement. Capital markets are markets that are used by governments, individuals, and companies for raising money for long term requirement. So when you invest in money market, your money is being used for short term requirement of government, individuals, or companies. So favorable return rate of return based on current interest rate allows some check writing. So they have a better rate of return than all above. Higher minimum balance than regular savings account. No interest or service charge if below a certain balance. So these are the things. Money market funds. So instead of having an account where you directly invest, you can have a fund that indirectly invests in money markets. So favorable rate of return, minimum balance not guaranteed and fees not insured. So money market funds are not guaranteed. Money market accounts are also not guaranteed. So you can lose money on money market funds as well as money market accounts. Canada savings bond rate of return varies with current interest rates, low minimum deposit, regular or compounded interest. There is a government guarantee, no interest paid if redeemed before 3 months. So these are different options where you can options to your savings account. So evaluating a savings plan. So percentage increase in value due to interest, it is called as rate of interest or yield. So what is the yield on your savings account? Compounding interest on interest and effective annual rate. So we have discussed effective annual rate when we were discussing time value of money. If compounding is not happening yearly, then the rate that you actually get is different than rate that is mentioned on the instrument. For example, if you're getting 6% rate of interest annually, right, but the compounding is happening semi annually, so you're getting interest paid every 6 months, so you're not going to get 6%, you're going to get little higher than 6%. That is called as effective annual rate. So you have to focus on what is the interest mentioned, and you have to also focus on what is the compounding period. Lower the compounding period, more interest you would get. So if I have given an option between a monthly compounding at 6% or and semi-annual compounding at 6%, so both has 6% rates, but one will pay me interest monthly and one will pay me interest semi-annually, then effective annual rate on a monthly is better than a semi-annual. So as the period goes low, the interest rate goes up, the effective annual rate goes up. Inflation. So compare returns with inflation rates. So your return should be more than inflation rates, otherwise you're losing money. Tax consideration. Taxes reduce interest earned. Liquidity, ease with which you can convert to cash with minimum loss of capital. So certain things are liquid, certain things are not liquid. Liquidity means you can easily convert it into money without loss of any capital. So check-in account has very high liquidity. Safety, Canadian Deposit Insurance Corporation CDIC insures up to a maximum $100,000 per person for financial institution. So I have I'm a millionaire. I have a lot of money, right? One option is I can keep $1 million in one bank. Now, if the bank goes bust, my money is only insured up to $100,000 because $100,000 per individual per financial institution. So instead of keeping $1 million in one bank, I can distribute it to 10 banks with $100,000 each in 10 different banks. Now, my each account with each bank is insured for $100,000. So you have to, if you have a lot of money, you have to remember this. Distribute your money so that you can get advantage of this free insurance that is available. But if I have two bank accounts with the same financial institution, so let's say I have a bank account with Scotia and I have two accounts with them. One has $50,000 and another one has, let's say, $150,000. So the combined balance is insured for $100,000. So it's not that my bank account 1 is insured for 100, my bank account 2 is insured for 100. The combined balance is considered. So if you have money more than $100,000, you should ideally distribute it in different banks. Restriction and fees, delays between interest earned and added to your account, transaction fees for each deposit or withdrawal, interest paid with minimum balances. So you have to consider all of this. Types of checking account. Regular checking account usually have a monthly service charge that you can avoid with minimum balance, but if you keep minimum balance, we know there is loss of interest. Activity account charge a fee for each check return. Interest earning checking accounts require a minimum balance, but it is not zero interest paying, it pays certain interest. So check-in account selection factors. So check for restrictions like minimum balance, deposit insurance, hours and location of branch. So it's prudent to have a branch that is closer to your residing place or your workplace. Holding period for deposited checks. You have to consider fees also, monthly fees, fees for each check and deposit, printing of check, fees to obtain cancel check, overdraft, fees for pre-authorized credit. So you have to consider all this. You consider interest that they pay as well as special services that they are providing. So you can just go through them. It's relatively easy to understand. So evaluating checking account, you need to consider restrictions such as minimum balances. So there is a zero balance account, there is a minimum balance account, fees which are increasing, and charges. Interest that they provide, special services such as phone banking and teller machines that they have. Then overdraft protection. Overdraft is if you go below zero, then what happens? Then they charge certain fees, so because it is considered as a loan to you. So I have a checking account which had $1,000 into it, but I did a transaction that is $1,200. Now I did not have that $200 into my account, so that 200 is considered as overdraft. So that overdraft will be considered by bank as a short term loan. So they would charge interest on it as well as charge fees to me for withdrawing over my limit. So whenever you withdraw over your limit, you have to pay two fees: interest rates on the amount withdrawn as well as significant amount of fees for using that facility. So instead of, if you think that you may sometimes go overboard, so instead of just withdrawing that money, you can buy this, you can subscribe to this service called as overdraft protection. Overdraft protection means they will charge a lower fees and they will charge lower interest if you go overboard. Automatic main loan made to cover checks return in excess of account balance. So this is something that we'll discuss in class because it is little bit complex. So this is how you find which account to take. So on the left hand side you have average balance by, okay, so do you take a checking account that has minimum balance, or do you take a checking account that has zero balance? So this is the comparison between two. So depending on whatever average balance you have seen in your past checking account, you can, so let's say my average balance has been $1,000. I have always $1,000 in my account. So it is better to take $1,000 minimum balance account than to take a monthly service fee based account. Other payment method: certified check, personal checks with guaranteed payment, cashier check, check of financial institution you get by paying the face amount plus a fee, money order purchase at financial institution, post of it at a stores, traveler check, sign each check twice. Traveler check no one uses these days when we travel, but in earlier times it was the most convenient way. So traveler check is a special type of check. You have to sign twice on it, and it is prepaid travel card. We generally use this now. Prepaid travel card with ability to get local currency at any teller machine. So we have seen different financial products: savings plan, checking account, loan and trust services are used for managing daily financial activity. Technology, opportunity cost and economic conditions affect the selection and use of financial services. Chartered banks, trust company, credit unions, and quasi popularies are types of banking institutions. Non-financial or non-deposit based institutions are life insurance companies, investment companies, mortgage and loan. Pawn shop and cash checking outlets charge you significant amount of fees. So whenever you are choosing, you have to consider services offered, rates and fees, safety, convenience, and special programs available for consumers. So you have different options like regular savings account, term deposits, interest earning checking account, guaranteed investment certificates, and Canada savings bond. Factors you have to consider: rate of return, inflation, tax consideration, liquidity, safety, and restrictions and fees. Regular checking account, activity account, and interest earning account. Regular checking account is a zero balance account, but it charges service fees. Activity account doesn't have a monthly service fees, but it charges on activities that you do in the account. So it doesn't have a fixed monthly fee or a fixed annual fee, but it charges fees based on activities that you do. Interest earning checking account has a minimum balance. Compared to restriction, fees and charges, interest and special services. So this is what we have seen. So thank you. We'll continue in the next session.